Good afternoon, everyone, and welcome to our quarterly investor call. Slightly different from our other webinars throughout the year. These investor calls are a little bit longer at 90 minutes, so it enables us to have a little bit more of a robust discussion. But they're also case study based, so the audience can kind of take away some real life examples of transactions in today's market. And we've gotten a very good response on these calls for the last year. So excited to do another year of the investor calls. And we're very excited to have Blueprint as today's sponsor. Blueprint was founded in 2013 with a mission to elevate healthcare real estate advisory through collaboration and data. Today, Blueprint is the most active advisory firm in seniors housing and skilled nursing, and a market leader within other healthcare real estate subsegments, including behavioral healthcare and medical properties. The firm also offers a dedicated capital markets practice to support clients with financing solutions. And with a proven track record of $14 billion in transaction volume, Blueprint's model combines broad market coverage with unrivaled analytics to deliver results. So thank you, Blueprint, for sponsoring today's webinar. And thank you to Kyle Hallian, who's joining us as a panel today. Prior to making his move to Blueprint in 2021, Kyle served as Director of Asset Management at Ventas, overseeing a portfolio of nearly 400 communities across 25 operator relationships. And he brings over a decade of healthcare real estate and commercial lending experience. So it's great to have him on. Welcome, Kyle.
Glad to be here. Thanks, Ben.
And next, Corey Wake joins us from Silver Wave Capital, an active investment firm in the M&A market that partners with retail and institutional capital to acquire seniors housing communities. Over his career at American Eagle Life Care Corp, and also as a GP, he's closed over $400 million of transactions, and he's got an active pipeline right now. So excited to hear more about that on today's call, and glad you could join us, Corey.
Yeah, likewise, Ben. Thanks.
Last, we have David Young. He's a managing director at Greystone, where he focuses on originating and structuring senior loans for the firm's FHA lending platform, plus other permanent financing solutions. Before that, he was at Locust Point Capital and was also the CFO for Radiant Senior Living. The lending environment has certainly played a pivotal role in not only the M&A activity of the last couple of years, but really on valuations. So very happy to have David's perspective on this panel. Welcome.
Thank you, Ben.
So we'll be covering a lot of ground in the M&A and financing space in today's call. Kyle is first going to present a case study on a Class B seniors housing deal. Following that, Corey will be presenting some of his internal statistics on all the deals that have crossed his desk from the last year. So excited to hear what he has to say there. Next, we've got some three varied mini kind of case studies presented by David, focusing on Greystone's debt execution side. Kyle, and then Corey is going to talk about three kind of value add deals that he's currently looking at. Kyle's then going to take us home as far as the case studies with one on the SNF market in Kentucky, which recently saw a big change to its reimbursement environment. And that's had a big influence on deal making and values there. And we may cover a few other states that have kind of seen similar jolts to their M&A markets within the SNF space. And finally, if we have time, we'll cover a few other pressing topics. And of course, throughout the call, we're going to try to answer as many audience questions as possible. So if anyone in our audience has a question, they can enter them in the Q&A box within the Zoom window, and we'll do our best to get to it within the hour and a half. Also, if anyone has any technical difficulties with today's webinar, you can email us at Levin, info@levinassociates.com. If anyone has any questions about our different publications, subscriptions, and the M&A data that we have to offer as well, feel free to reach out to me after the call or contact your account manager. We'll be very happy to talk about our different offerings. Lastly, at the end of the webinar, a survey will appear, and we really appreciate everyone's feedback. It improves our future webinars, but also it lets us know what we should do for future topics as well. So thank you in advance for everyone who fills out that survey. And without further ado, Kyle, do you want to kick us off with your first case study and maybe kind of why you chose this one as particularly emblematic of today's M&A environment?
Yeah, 100%. And so I think starting off high level here too, we wanted the goal of this conversation is talk about live deals, right? How is the M&A market impacting today, trending today versus prior periods, right? So we felt rather than talking about deals that closed at the end of last year, let's talk about what we're working on today and what we're hearing live from various market participants. And then, ultimately how that, is impacting the environment out there. So what we've chosen today is a deal that we're currently working on in North Carolina, located in the Raleigh Triangle area. Absolutely fantastic market. It's an AL memory care community, about 80 units. Very solid performer, consistently running around 95% occupancy. Solid in-place cash flow, but certainly some margin upside, at kind of an as-is basis, and then potentially through a CapEx play here as well. I think in terms of why we're talking about this, it's, this is an opportunity that we really felt, could demand very strong interest from the marketplace. North Carolina, as a lot of you all know, is a certificate of need state, which heavily impacts historical and future development, which really gives existing investors and operators a really nice runway to continue to capture the demand that's in place. But in terms of this asset, a little bit older, 2000s vintage, very strong demos, both from a home value and population growth perspective, but taking a broader step back, I think the sub-market here for IL, AL, memory care, all 93 to 95+% across all competitors. So very compelling deal. This was kind of a unicorn. The asset is REO. It sits with a national lender, and we were engaged to go out and start a process. So this is a deal we launched in at the end of last year, mid-sized process. Went out with a big number, and again, it was a very attractive deal, and we saw that certainly via the market's response. So, that's the high level in terms of the profile of the asset. Ben, I think we can go to the next page and talk about the market's reaction, and obviously answer some questions. Given the mandate here, very motivated seller, like I said, REO. So from our perspective, we wanted to be, really capture two things: efficiency and then pricing certainty, or maximize pricing. So we ran a mid-sized process, sent about 50 investor and operator groups, the likes of public REITs, private equity, regional and local owner operators, and some developers as well. About a 75% response rate, which I'd say on NDAs, which is a little bit above average, very encouraging. We ran about a 30-day marketing process, and Ben, that's one thing that I'd say has shifted in today's environment. We are seeing initial marketing periods compress, given the interest that's out there and the demand for deals. We received 6 written letters of intent, initial round pricing. Guidance here was close to 200 a door. The initial offers that we received around 175 to 190K per unit, and the pool, if you will. Several regional owner and operators and developers in North Carolina heavily attracted and interested in this opportunity. You have a national owner operator who got in the ring, and then private equity as well. So from next steps, how do we get from initial round bids to ultimately where we can take this offering? Obviously, when you're doing this business, we have to be sensitive about the operational nature of these communities, right? So you have staff, you have residents, and it's very important that confidentiality is maintained throughout. So despite the strong interest that we received on the initial round, we did want to narrow this down to limiting to 2 groups for final round tour. So we brought out 2 groups, both North Carolina focused, both with regional, operations in the area. And after we did a formal buyer tour, push for final and best offers, and it was a tremendous result. So I think what helps when you bring buyers out, When your building's near 100% full and you can only see a model room, that certainly helps, with the story. But I think what was most impressive is the demand for this asset, right? And so we saw about a 10% pop in final round offers versus where initially came in. Right now, the deal is under contract, trading for a little bit north of 200 per unit, in about a 7.25 cap on in-place income, but certainly anticipating, some stabilized margin growth going forward.
Got it. Kyle, was the competitive bidding environment kind of the only reason why the price ended up increasing by around 10%, or had operations maybe improved slightly throughout the process?
Yeah, I mean, occupancy held steady throughout the entirety of the process, right? And so when you can take a deal out that's running at 95% and you span the course of 2 months of data throughout the marketing process, and they maintain that financial performance, that I think that really it helps the process, right? I mean, sometimes we've seen assets go backwards, which can make things a little bit more complicated, but your performance remained consistent. I think the tours from a buyer's perspective went very well. It helps visualize the opportunity that's in front of you rather than just the desktop analysis. And I think ultimately what attracted folks to the deal is, the in-place performance, the upside that was there, which we can talk about here in a little bit, but really the market in general. I mean, this is the spot where you wanted to be, surrounded by great, demographics from a private pay senior housing perspective. And then obviously it's North Carolina, and you're going to be muted from that future supply growth. So I think that the biggest component here of ultimate in the price increase was the competition that we saw, and we were able to leverage that competition. It's going to be a great deal for the buyer, but where we're sitting right now, this is an absolute home run for outcome for the seller as well.
I'm curious if there's any other prospective sellers on the call right now. Can almost everyone expect almost a 10% bump in the purchase price for their facilities in this current market, or what about this particular asset led to that being the end result?
Yeah, I don't think so. I mean, do you as a broker and a seller anticipate some movement from an initial round to a final round? Certainly. Tours have to go well. You have to kind of mitigate any sort of unknown CapEx issue that might be present that it wasn't previously known before. So generally speaking, I do view this one more as an outlier. There's also probably other product types, that we're seeing in different markets where you can also expect. But no, I mean, I don't think all properties in markets are created equal. You're going to see certain investors attracted to certain asset classes in certain locations, while there's demand out there, it still remains challenging, to meet sellers' expectations and ultimately get the job done. But I think broadly speaking, really what drove this year was the market, in-place performance, and there was real upside that we believe could be captured within a 6 to 12 month time frame. And we were sure to tell that story to all the folks that we were chatting with, and ultimately, we achieved the outcome that we were looking for.
What are some of those other property types and markets that you've seen, especially active bidding environments?
Yeah, 100%. And I think it's largely more so on the institutional side. So newer vintage, primary, secondary, NICMAC markets, I think that's certainly important. I think in terms of the deal profile itself, any sort of combo of acuity, IL, AL, memory care is absolutely perfect. IL, AL memory care, that certainly works as well. And then I think the unit count and the size of the building is also a driving factor. So 100 plus units, I do think, as you kind of get smaller, 80, 75, 65, et cetera, you do start to lose out on some folks. But I think in terms of, really the overall demand, it's the profile of the asset, it's the market. And then whether it's a, fully stabilized new vintage asset, you're going to see a tremendous amount of demand from the larger players in the space, both on the public and private side. But I think in terms of, everyone's favorite deal out there, new vintage asset, operationally struggling, maybe 70 to 80%, some cash flow, We've seen, some of my colleagues have a couple of those examples on right now, and the investor feedback on those has been absolutely tremendous.
Corey, do you agree with that? Are those the kind of deals that you're most looking for right now?
Yeah, I mean, I think that's definitely kind of the Goldilocks deal, as Kyle indicated. There's certainly there's a variety of deal types out there that are attractive to us, and shedding any one of those variables that Kyle articulated doesn't necessarily make it a deal that we're going to pass on. We have a deal that fits all those criteria except for the cash flow criteria at the moment. It's negative NOI that we're very excited about. But I think really from our perspective, anything that it has good bones, is in a market where, by all indications, the facility, the demand for the product is there, and the community can lease up, and the unit sizes are competitive, and it's not a building that is sort of headed towards functional obsolescence, and it's trading at a healthy discount to historical valuations or replacement costs, depending on the vintage. We're excited about. But again, yeah, I completely agree with. I sort of chuckled as Kyle laid out that set of criteria, because it is the sweet spot, and it's what everybody's after.
Did you look at this deal, by the way?
We did. We pretty quickly passed on it because I thought Blueprint presented it very fairly, and I thought their pricing guidance was dead on, and it just isn't a deal that had quite enough meat left on the bone for us. And so we just decided that our time and energies were spent elsewhere, or better spent elsewhere.
Like not enough meat on the bone as far as not enough room to improve operations
Yeah, I
and
mean, so
value?
just the fact that it was 95% occupied, certainly, Kyle told us that there was some upside here in terms of sort of streamlining operations and expense control, and we believed that, but we're just generally, we're IRR driven investors, and so we felt that at the basis per door that was being guided to, combined with sort of the vintage of the community, that when all was said and done, our IRR was probably going to be lower on a transaction like this than we typically are searching for.
Well, it made for a happy client on Kyle's part, I'm sure. I'm just going to quickly go
Yeah.
back here. Kyle, I had a question about the pro forma NOI margin. So this is a 2000s vintage, roughly typical size for an AL memory care community. Is that 26% margin kind of the max for these kinds of assets that you're seeing?
I don't think so. With this, that pro forma margin that we've outlined here, that's really under an as-is scenario, right? If you look at in-place rates today, blended RevPORs are 7,500. It's fantastic. If you take a step back and look at the broader market, memory care running average 9,000 per month, AL high 7,000s per month. So you certainly have some room to grow from a rate perspective. But I'm sure one of your questions is, is CapEx warranted here? And there was an opportunity to invest in CapEx, right? I mean, the building works today. It's full. It's great. It's making a decent margin. But I think what folks saw was the ability to, okay, we can invest some dollars here, spruce up the units, put some dollars in the common areas, and really get a little bit more competitive on a pricing perspective. So we've looked at a number of opportunities throughout the state of North Carolina over the past 2 or 3 years. Anywhere between a low, high 20s to a low 30% margin, that's not out of the realm of possibility. So this was more so, you come in, you stabilize operations, you eliminate some of the overtime and agency staffing, very high referral fee expense, which impacts your marketing dollars. Some just a little bit more of the basic blocking and tackling. And I think what was also impacted, really margin profile here is you have an out-of-state operator. Anytime you have a single community in a single state, it naturally brings some inefficiencies. So I think what attracted folks to it is, they had a couple assets in the state, regional infrastructure, fairly, attractive negotiated contracts that they can bring into this building day one, and ultimately drive some value. So, I would tell you the 26% is more of a, hey, what can you do in the next 12 to 18 months with the building as is? But certainly I would think through incremental CapEx investment and some dollars into the units, that there's some attractive pricing upside, and wouldn't be surprised if this gets to somewhere in the 30s in the very near future.
Question, Kyle. Do you think is the buyer here? What's their strategy? What's their hold period and exit strategy?
Yeah, I mean, I think longer term focused. Not it's private capital coming directly from the principals, not driven by certain fund life issues or outside investors looking to hit a 3 to 5 year return. So I think certainly what the benefit here is you have a more longer term patient capital that is willing to see this through the long term.
So if you've
Yeah, and
got,
that,
go ahead,
go
Corey.
ahead, David. I was just going to say that that strategy makes a lot of sense in a CON state, particularly where the
Yeah.
threat of new construction is low.
And where my mind goes is if you've got, like Corey mentioned, like this isn't necessarily like Corey's perhaps focused on heavier value add. If you're going to divide near stabilized deals, unstabilized deals, and a light value, heavy value add, perhaps I'm wondering if a light value add deal with a longer term hold, which you're going to get better financing up front, allows for people to stretch more, Kyle, and hence that 10% pop. Do you think there's
Yeah.
some credence to that, or
Well, I think what certainly helped is you have a national agency lender that had a very long track record with this specific sponsor that was jumping in to do this deal, right? And so when you have a lender that's encouraging you and able to give favorable terms from an LTV perspective, that certainly helps your upward mobility and gives you confidence in the deal over turn. So, but yeah, I mean, I think in terms of if you're a shorter term holder, looking somewhere between the 3 to 5 years, basis is very important. You want to make sure that you buy right. There's challenges in this business. Operations is not easy. As we've all seen it, there's been a bunch of headwinds that have come our way over the past 5 to 7 years. But buying at the right basis, especially in that shorter term, it allows you to make those mistakes here. But I think in terms of this group's holding period and how they can integrate this within the rest of their portfolio was certainly a plus in terms of where we were able to take it.
David, I have a question for you from the lender's perspective, the selling lender's perspective in this deal, since it was REO. Is there any, what can the lender do to maximize proceeds in this situation? Because in the last few years, for any of the lender directed sales, that's where you've seen the greatest discounts for these properties. So what can the lender do if they're approaching a process like this?
exercise patience? I mean, we saw a few deals last year where you had in place lenders, deal was about to go REO, and they're trying to offer financing, and you got to be careful though, because a lender can incur lender liability if they're trying to, if the existing borrowers can make an argument that's the lender's getting their fingers in the pie operationally too much. And if it doesn't go as the lender suggests, then that can be thrown back on the lender's face. So you got to be real careful from a lender liability perspective. As it relates to something that's been REO, there's probably a receiver in place, in which case that's very expensive. And so patience is, there's a tension between patience for the capital markets to right size. Here, though, you've got a mid-teens NOI margin and 95% occupancy. That's pretty impressive for an REO asset. So there, it's simply just going to market. It's a balance. And frankly, I think what can a lender do? It's more along the lines of what are the in-place metrics? Is there any operator alignment involved? Do they have existing rights in their docs over the do they have a pledge of the equity, for instance? Can they exercise that? If it is there, then they can exercise that in order to change out operations, being careful how they walk the line of lender liability, things like that. So you get into the weeds, but there are some levers you can pull.
Got it. Thanks. Any other questions for Kyle on this case study? Or Kyle, anything else you want to mention on it?
Just on that last question to Dave, what can lenders do? They can hire Blueprint.
There you go.
Dave, you agree?
Hands down. Well, look at the result.
Exactly. Hang on, let's go to the result. There we go. The 10% increase in the price. Any other questions? Any other comments on this case study?
I guess I'll just say, we're about to get into some of our internal data, but we've recorded since we launched our firm in January of 2024, we've recorded 314 deals that we've reviewed. And of those 314 deals, we got transaction prices for 51 of them. So we have both guidance and transaction price for a total of 51 deals over the last 15 months. And of those 51, only 4 of them traded at a 10% premium or higher to guidance. 20 of them traded above guidance, but only 4 of them traded at more than 10% above guidance.
There you go, Kyle. Making history. Well, Corey, that's a good segue into your statistics. So want to start hitting on those?
Yeah, I mean, so the theme of this webinar is what's different in 2025 relative to 2024. And so looking at our data set, we ran a couple of analyses here to investigate that question. And I think, broadly speaking, the theme is um, value add persists. It's not that value add has gone away, but thus far in 2025, there's a significant increase in the quantity of deals of listings that are both newer vintage and stabilized. So just taking these one at a time. So in the upper left here, I classified deals as non-performing if they were less than a zero, if they were a negative margin. I classified them as underperforming if they were a 5 to a 15% margin, and I classify them as performing if they were greater than 15% margin. People could quibble with those definitions. It's certainly crude, and admittedly, it lumps in independent living, assisted living, and memory care all into one bucket. But it's instructive nevertheless. And so you see this dramatic increase in the number of performing listings in Q1 2025. I will say that the data is a little skewed because we were just really busy in Q4 last year, closing on a deal that Blueprint brokered and did a phenomenal job. And we just fell behind on listings. So I don't think that our Q4 data accurately reflects the marketplace in terms of the quantity of listings that arose. Nevertheless, this green bar on the far right is really dramatic. The second graph, the upper right hand corner, shows average price per unit guidance relative to average EBITDA margin for all of the listings, and you see. I think that the broader trend in price per unit is interesting. You see a relatively steady increase from Q1 2024 through Q1 2025, with admittedly sort of flat in Q3 and Q4, but average price per unit guidance of 125 a door in Q1 of last year, average price per unit guidance of 190 Q1 of this year. And you see that average EBITDA margin is also significantly increased in Q1 up to 22%. Bottom left corner, you see the number of listings, the listings compared Q1 2024 to Q1 2025 based on vintage. So I looped them into vintage buckets, 1990s, 2000, 2010s, and 2020s, or rather I should say we lumped them in because my business partner, Elon Regil, he's the master architect behind this analysis and was incredibly helpful to me. And you see that in Q1 2025, there's a dramatic increase in the number of buildings constructed in both the 2010s and in the 2020s. And so you see newer buildings listed. And then this bottom right chart, is it doesn't delineate between 2024 and 2025, but I just think it's interesting. It just shows the number of listings by state. And so Florida, Texas really dwarf the rest of the states. And then you have kind of Michigan, Georgia, Ohio, Colorado, California, and South Carolina as like the sort of tier 2. So I think these charts collectively paint an interesting picture where the story is buildings are newer and performing better. And I chatted with brokers. We are always chatting with brokers, and chatting with brokers sort of in preparation for this webinar, and just to kind of get their perspective on what's different about this quarter, this year relative to last year. Everybody agrees that newer, nicer facilities are coming to market, and I think the story behind it is just it's a multitude of things, but a lot of it has to do with the fact that there is a backlog of folks who have wanted to sell for 3 or 4 years and have just not sold because performance has not been there. They developed them in the late 2010s. They were intended to be 3 or 5 year holds, in many cases, they're still on construction loans that have been extended multiple times. And last year, it's like every quarter, every time NICMAP data came out, it looked better and better and better. Occupancy is trending the right direction. And so I think you just finally have a lot of the sort of pent up seller demand starting to wash through the system as people get performance where it needs to be, have held performance where it needs to be for a long enough time to get folks to underwrite to like a T3 or a T6. And excuse me, and a lot of these folks, they're not hitting home runs, but they are, many of them are making money. They're singles, they're doubles, and they're fatigued, and it's time to get out. Or they're up against it with their lender, and there's no more extensions, and it's time to go. So that's really what we're seeing this year. And as value add buyers, we've been a little bit concerned by this because, well, I guess for obvious reasons. And I have been assured by all of our broker friends that plenty of value add is still here. Plenty of value add is still coming. There are plenty of folks that have extended maturing loans that have not seen performance get where it needs to go and are going to be selling this year. Brokers continue to do BOVs for banks. And I think that this year it's just going to be a much broader diversity of listings than last year. And we're going to see stuff kind of of all stars and stripes.
Do you agree, Kyle? Have buyers not missed the value add opportunity?
I agree. The operational intensity of this business, there's always going to be value add opportunities, right? And, unfortunately, there are times where you got mean, tough lenders like Dave Young that, force their hands to go out there and sell in certain instances. But listen, you can have a beautiful building in a really good market, and you make the wrong hire on the executive director front, or you have some turnover for whatever reasons that can impact your performance. Send occupancy in the wrong direction. And given the various levels of seller motivations out there, I do believe you will continue to see value add opportunities in this space. Now, not to the level that we saw in 21, 22, et cetera, but the opportunities will always be there.
And likely not the same share of deals and listings that we were seeing in the last couple of years as well.
Yeah.
Corey, that's why I'm happy to hear that we're going to see more variation in the types of deals in 2025. Some higher quality stuff, more performing, as we can see from your first chart here.
And think about what the equity's gone through on these deals that are 2015, 16, 17 vintage. Think about the last 5 years and how many capital rounds and dilutions, and you had the pandemic, you had inflation, you had SOFR. Remember what we were dealing with when SOFR started increasing 2.5 years ago. And so, the bid-ask spread seems to be, from our perspective, tightening, or at least meeting in many cases.
Yeah.
So why do you think the 2010s vintage here spiked so dramatically? And I guess another way to phrase that is, why were so many 2010 vintage properties not selling last first quarter as opposed to this past first quarter?
Yeah, I mean, I'm curious to get these guys' perspective on that. My instinct is that it's really just a function of the last 15 months have been incredibly good to folks who had properties that had good bones and were sort of like leaders in their marketplace. And there's just been a really dramatic improvement in census revenues, NOI at all these buildings, and so people finally feel like they can sell and they can get maybe not the exit that they were hoping for 5 years ago, but an exit that they were hoping for 3 years ago. And they just, they feel like they can make money on the exit.
Yeah, I agree with Corey. I do think it's a combo of factors. One, increasingly improving, investment market, new entrants, sideline investors that are back and active today. But it's really the performance and the demand fundamentals. Occupancy is higher, rates are higher, margins are higher, and what may have been a non-palatable sale 2 years ago is they can go out today. They can hit a double, get their money back, make a little bit of a return, and move on to the next one. So I do think it's a combo, and you probably have some developers in here as well, where lease up stalled, and that certainly impacted expectations. But I bet a lot of the private equity funds are making up the bulk of that big green bar in the 2010 silo.
And
Yeah.
if they
And I go ahead, David, go ahead.
I was going to say, to Kyle's point, if they can get their basis back with a modest return, that's a home run relative to who knows what the forecast was 2 years ago. I think people shelved the crystal ball, right? So that's and those metrics are only improving in general across the board. So
Yeah, and I think the story is predominantly just about improving performance, but I also I anticipate that there's probably also an increasing sense that there's just like there's more liquidity in the market. I mean, I wasn't at Spring Nick, unfortunately, but I was at Fall Nick, and it was like everyone was talking about how debt liquidity is starting to come back. Although I'd love to hear David's perspective on that because I've been hearing that for a while, and it doesn't exactly map onto our experience. But certainly LP, a lot more LP equity is coming into the space, and so I anticipate that when you layer on top just a general sense, a general perception that more and more capital is coming into the space, especially relative to 15 months ago. On top of the fact that performance is improving, people probably just feel like now's a good time to sell.
David, is liquidity back?
it depends. How's this for an answer? It depends. Um,
Yeah.
in general, I say yes. I think that, I mean, think about it this way. Kyle made a comment about in the North Carolina deal, about funds who may not have, I'll put it in my words, funds who may not have like 2021, 2020, 2022 investments and say fresh capital with nothing previously invested. They're able to bid well. So that's similar to, say, LPs who want to buy right now, relative to many of those LPs, to argue, or the LPs who were investing, say, 2016, 17, it was all about new development, right? And now it's not at all really about new development. It's 90% about acquisitions, simply because it's all relative, right? What's the price you're going to pay for new development, fully loaded, all in, right? Versus an acquisition with a few reserves, maybe on a per unit basis. So to your question, though, capital is definitely more available now than it was. It simply just depends on it all depends on the in place. It's the in place cash flow, and then secondary to that, it's more about the sponsorship, and then third to that, it's more about, okay, how does it frame to the exit, right? So the agencies are focused on primary, secondary markets. HUD is focused on something completely different. And what's your exit? Is it So I'd say I'd frame the answer around those points.
Yeah. I think that's helpful, David. I think one question that these charts beg is the increase in pricing guidance in um in 2025, is it purely a reflection of the fact that the vintage of the communities is newer, and so it's just like higher price per pound for that reason, or is it a question of improving performance, or both? And I mean, the answer, I guess, sort of obviously is both. But we did drill down on this a little bit, and I think that the takeaways were interesting. And so there's no question that, if newer communities are being sold, the average price per unit is going to come up. But we looked at, we mapped on our price per unit chart. We filtered we put time on the x-axis by month, so January 2024 through April of 2025, and then we filtered by sort of that vintage bucket that I articulated earlier, 1990s, 2000s, 2010s, and 2020s. And what we saw is that in for both 1980s and 1990s communities, there was basically no discernible trend in price per unit guidance from January 2024 to present. It was up, it was down, it was erratic. But for communities that were constructed in later than the year 2000, so 2000s, 2010s, 2020s, there's a very discernible trend where price per unit has been increasing over the last 6 months. And so I think that what that speaks to is the fact that um, the rising tide may not necessarily lift all boats. The rising tide lifts the boats that have offerings that are attractive to prospective residents. And so, communities that were built in the 2000s, the 2010s, the 2020s, they just have good unit sizes, good common areas. They're more attractive to folks relative to some of the older stuff in the market. And so I think the rising tide is really, at least this is purely based on our internal data. the rising tide seems to be benefiting communities that were constructed, call it within the last 25 years, a lot more than communities that were constructed prior to that, at least when evaluating trends in pricing guidance.
Well, I imagine the lack of new construction makes the 2010s vintage seem that much newer, kind of relative to any other time in history when a 10-year-old community would be looked at differently. Lack of new construction, a 2016 vintage community, and you guys can, if you're seeing otherwise, speak up. But a 2016 vintage community, because of the lack of new construction now, is still looked on as relatively new. Would you agree?
Yeah, there's no question. I mean, and you guys at SeniorCare Investor have done a really good job writing about this. It's just we're in this kind of unique period where communities that were built within the last 10 years, they they are positioned to benefit for a longer period of time than is historically normal as being the sort of newer product offering in their market because new construction is so low and the threat of new construction remains so low. So it's just one more reason that buying versus building is a particularly attractive proposition.
And the the proposition, an acquisition of a 10 to 15-year-old community that's 60 to 70% occupied, may have some operational hair. Perhaps that trades right now from what we've seen, let's call it 200s per unit, somewhere in that range of 200s a door. To build that brand new, 350 to 400 a door, and you have construction risk, and you got to get up to 60% occupancy to be at your comp. So which one would you choose?
Yeah. That's why I didn't even include any new development questions.
Smart man.
Kind of last question before we move on to David's case studies. Corey and David and Kyle, what age do you see as old in today's market when you're looking at a property? Is it, anything before 2008 is old, anything before 2013 is old, or anything before 2000 is old? Kind of where do you stand on that? Very generally speaking.
Yeah, sure. So that good caveat. I mean, very generally speaking, I'd say 1990 is our firm cut. Like we basically just won't look at anything that was built prior to 1990. CapEx needs are too high, and just as a small team, like CapEx, it's a lot of work, and it doesn't entice us. 1990s communities we will look at, but we kind of consider those old. I'd say 2000 is sort of the cutoff for us, perhaps somewhat arbitrarily between kind of old and new enough.
I mean,
Kyle, David, do you see it differently at all?
I would say it really depends. Oregon memory care,
Yeah.
the question doesn't apply because you're getting 6,500 plus reimbursement for Medicaid waiver. Minnesota similarly. So if it has a good Medicaid waiver state, I'd say you could be just fine there. Now your financing options are really limited, but you're going to have investors that like coupons and this long-term hold. But in general, 1998, for some reason, that number sticks out in my mind, 1998.
So that construction boom that kind of started in the late 90s, early 2000s.
It's the old Brookdale product.
Yeah. Kyle, do you agree?
Yeah, about 25 years, give or take. And I agree with Corey. An interesting factoid, you can have a fully stabilized build that was built in 85, good market and everything, but it is a very difficult sell given the vintage. And I think that really comes down to, certain investment criteria, capital committees, and then ultimately people worrying about, 5 years from now, that building that was built in 85 is going to be 5 years older. So despite really strong demand fundamentals, that is a very tough product out there right now.
Yeah.
Well, David, you mentioned briefly Medicaid. And so I think that's a good segue into your first case study. You want to take it away?
Yeah, so these are deals that are live or recently done, and so they're pretty well anonymized for that reason. But the first portfolio this is acquisition financing that we provided Greystone with our in-house bridge fund. And it was effectively one thing that stood out here was that it's a near-term, immediate-term bridge to HUD execution. So we were comfortable stretching on loan to cost. Whereas a year ago, you wouldn't have seen a loan to cost close to where we stretched on this one. That was further, it was the comfort was there, particularly because the state had a strong Medicaid waiver, supports seniors. It's very demonstrably supportive of seniors housing, and it had good HUD execution. So that's effectively in a nutshell where we're performing right now. And I wouldn't have seen that. That probably would have been 15% lower loan to cost a year ago, Ben, off the cuff, for what it's worth.
That's significant.
Yeah, and the second one, you want me to just roll into the second one?
Just quickly on the loan to cost, why exactly? You had mentioned kind of what got you guys a little more comfortable with the higher loan to cost, but why would that not have happened last year?
There was a strong reimbursement rate increase in the state last year and throughout the year. And that enabled the price that the buyer paid to be largely going straight to HUD. And so that allowed, because as you know, bridge to HUD lenders, many people are looking to their exit, right? What's our exit? Is our exit attainable? How attainable is it? And so having an attainable exit got us comfortable with stretching.
Got it. So what if there's any prospective buyers on borrowers on the call right now that are looking to get some kind of high leverage execution, what types of deals work for that in this current environment?
Seniors housing is more sensitive because the difference between your needed coverage and so there's just not as much positive leverage with seniors housing as skilled nursing, right? So seniors housing, it's harder to get a higher loan to cost as a result of that. So with that in mind, the assets that are eligible to go to HUD, you're looking, your programmatic leverage is 80%. So as a result, if you're performing well enough to go to HUD at that leverage point, you're going to see more people stretch because they're confident they can take it to HUD on a near-term basis. Fewer folks are willing to do value add on the senior side because the value add is harder on the senior side. Generally, it's more top line because it's not a government reimbursed. Now, this Medicaid waiver is, but generally a top line seniors housing value add is a marketing issue, and that takes time. So you're going to see less stretching there. On the skilled side, you're going to be covering above a 10 debt yield, but you need a 16 debt yield to go to HUD. So you'll see folks take more of a value add risk on a bridge HUD basis for skilled nursing for what it's worth.
Thanks.
Yep.
Dave, I got a question for you. How much was this an existing client and sponsor that you all worked with before?
This was a sponsor that we had wanted to work with in the past, but had not yet closed a deal with. And we had actually talked about a couple of different deals previously last year. And this one came onto the forefront relatively quickly at the early part of the year. And we looked at it and sized it up and said, this works. Let's move on this quickly. And so it worked out really well, conveniently.
David,
Now,
is that
was
go ahead, Kyle.
I got a follow-up question. If this was the same exact deal profile with a new client and prospective buyer that you all had not worked with before and you were not familiar with, do you all see yourself stretching like you did in this instance, or is there some validity to the sponsor strength and your all's desire to do business with them?
Well, there's certain validity to the sponsor's strength, to your point. Absolutely. We do a deep dive on the sponsor. Particularly, Kyle, what's the ability of the sponsor to provide follow-on capital if something goes wrong during the bridge hold? That's the question behind the question, right? Is when people say, hey, what's the guarantor strength? Well, that's really what they mean. Global cash flow and so forth kind of feed into that answer. So, but if you present a portfolio of communities and you're able, and the pricing is right such that you're able to go to HUD on a nearly complete your basis in a near-term manner, 12 to 15 months from now, that's pretty compelling. So you're going to see a bridge to HUD lender stretch on that. And thankfully, we have Greystone has a very active balance sheet right now. And so they're able to capitalize. We're able to capitalize on those opportunities right now. I'd say for a bank, when I'm out in the market, because we have a very active bridge fund, and I run a very active placement desk. So I'm also working with a host of banks and credit unions and debt funds. Those debt funds are either levered or unlevered, right? So the senior debt funds, some of them are unlevered, some of them have like fund leverage, and some of them prefer AB, so like project level leverage where you'll see it. This deal, a bank would care most about the relationship, but a bank wouldn't stretch to the loan to cost we stretched here because there's for them it's about the relationship, not so much about throughput to the HUD, if that makes any sense.
David, so that it was very interesting insight about the lenders' willingness to stretch further on the bridge piece for skilled nursing facilities because of the comfort that government reimbursement brings them. I'm wondering, is that changing or at least at risk, or are people starting to voice concerns on the lending side relative to some of the chatter coming out of DC about, Medicare, Medicaid cuts, or are people kind of looking through that and just anticipating that those won't happen because they just can't happen because it would be too devastating to the industry?
Well, no one, no,
Could I add
yeah.
some certainty about the HUD queue length in the near term as well?
HUD
And
queue
comfort
actually
around
picked
that?
up in the last week. Last update, they moved forward, I think 20 some odd spaces. So
Oh, good.
you will see some efficiencies come out that are known probably in the next month or two. And so, Greystone gets so many reps out of all the deals that they have across different teams with HUD. They're constantly talking to HUD and disseminating that information among the originating team in order to basically just be getting as much real-time updates as possible. Corey, to your question, how political the landscape of the reimbursement landscape, no bridge to HUD lender of scale that raises capital from LPs, international LPs, whether it's us or others, no one's going to take a Pollyanna view of things, right? At the same time, no one who is a long-term lender in the space is going to take a chicken little sky is falling view, right?
Yeah.
So those are the two extremes for what it's worth, the two ditches you want to avoid. Now, that said, the whole reconciliation process behind the budget proposed by the House and the budget proposed by the Senate, that's going to take a few months. Where will it land ultimately? Just say that we don't have all of our assets, delegated to UPL communities, for instance. There are some areas of reimbursement that are concerning, right? But if you continue the blocking and tackling of sane sizing, you're generally able to minimize your losses, put it that way. And by losses, what I mean is minimize those that don't exit in the time planned. And that's going through COVID. And we've seen we've seen a lot of payoffs too, which is obviously it helps us recycle capital. So I think that ultimately we'll be fine. As far as what it's going to look like, we'll probably know sometime in the summertime. But we're
Yeah.
continuing to lend through the environment on assets that make sense based on our credit metrics.
Yeah,
Got it.
that's helpful.
Want to
Dave, are
roll
you
into the new
seeing,
construction sniff as well? Oh, go ahead, Kyle.
I got one follow-up question. You mentioned UPL. Are you all seeing different valuation metrics today versus maybe 12 to 18 months ago?
Yeah, we're seeing people cut back rather than a cap rate, more of a multiple. What I mean by that, obviously, is simply instead of a 5 multiple, like a 1 or a 2, depending on the state.
Well,
But it's like, we'll see where that goes. But on the new construction, so this is a unique deal that the idea here, Ben, was to provide the audience with like, hey, what are we doing? And also, what are we getting done in the market? So what is the market doing?
Mhm.
And not just seniors, but also skilled, and not just private pay, but also affordable. So trying to hit the different access points for what it's worth. Now, this is obviously new construction sniff in a high barrier to entry state. And this is a bridge to HUD, but obviously you have to have at least 3 years seasoning before you submit the application. Not many bridge to HUD lenders have the ability to put something on their balance sheet for that long period of time. We do, and as a result, we're able to take an opportunity in the market and do a rather high loan to cost PropCo only deal, where we looked at the PropCos. We looked at obviously not just the PropCo ability, the PropCo guarantee and ability to right size the deal if something goes wrong, but also kind of an over the shoulder look of, hey, who's the tenant, what credit worthiness is the tenant, and just kind of like rubber stamping or double checking their own assessment of that tenant, because ultimately the tenant is paying the lease is paying the debt services. So that was unique, and that is an area where we're able to grow relationships that are important to us in the grander scheme of things as we grow that HUD business, specifically for skilled nursing.
How do you guys view the fill-up risk for a SNF like this as opposed to a new seniors housing community? I know that HUD has the 3-year seasoning requirement, but kind of how do you view it?
Excuse me. Well, so SNFs lease up faster than seniors housing. There are so few SNFs in certificate of need states, or states where it's just egregiously expensive to build new. Also, some reimbursement, depending on the state, favors private units over semi-private units. So all in, SNFs lease up quicker than seniors. What it comes down to, though, is managing the staffing, managing the operating deficit through that lease up, particularly given your quality mixes, your Medicare, your managed Medicare, your private pay to some degree. And those are very short-term stays. Those are, revolving door type stays. And so you have to manage your clinical as well as your therapy. But if you have a good operator who has good blocking and tackling in that and have demonstrated that on other lease ups, and you can vet that in the same state, then you're able to get confidence around their pro forma, the sanity checking their pro forma. And so then it just becomes underwriting to the guarantee, right? The guarantee of the borrower, and then understanding their underwriting to the tenant, in this case specifically. So lease ups to seniors housing, I mean, we've had a couple requests recently to refinance out construction loan at a seniors housing community that just recently opened up within the last year generally, and those are pretty much dead on arrival. Those won't be able to be refinanced. And we always tell them, look, just extend. If your term is that short, you simply have to extend.
Got it. Kyle, Corey, any questions on the new construction SNF?
What type of profile of a group is building new SNFs right now?
Limited profile. It's not common. This was a unique opportunity that we were able to strike while the iron's hot, Kyle, to be honest. And it positioned it's I wanted to list it here because I thought that it was something that most people simply aren't able to execute on.
Yeah.
That's all I can really say.
Yeah.
All right, awesome. Want to close it out with the Class A IL?
Yeah, so this is something, and now for something completely different. All private pay, recently built, recently stabilized, 100% occupied, secondary market, beautiful independent living. And we ran a mini process for this, where we reached out to a handful of debt funds and a handful of banks. It was at a debt yield, so the net operating income, the cash flow, was at a certain amount relative to the loan amount requested, where it was on the bubble whether or not it could go bank. It was, below general bank soft indications of, yeah, we'll do the deal, but it was well into debt fund territory. But obviously we wanted to see if we wanted to get bank pricing. And it came down to, and we did, which was great, but it came down to really just confirming in our mind, okay, where do debt funds play? Where do banks play? And at what point does it become a cage fight? over like where you could get a bank with certain metrics or no, it's a debt fund. And it really is proceeds versus pricing. Debt funds are greater on proceeds, banks are greater on pricing. Debt funds are non-recourse, bank generally. Banks are recourse certainly for any light value add deal, because this is really a light value add where you're occupied, but you're not yet fully stable, because it is a bridge to, right now it'd be Freddie, but it's a bridge to agency execution. We'll see if Fannie sharpens their pricing in in a bit. But ultimately, we were very pleased with the outcome, and it was out of the market pricing. There was 100 basis points inside of debt fund pricing, and that's aggressive debt fund pricing with an earnout structure.
Kyle, Corey, any questions on that?
Dave, educate me on the earnout structure. Educate me on the earnout structure. How do you all think about it, and effectively, what are the various metrics or hurdles that need to be hit, and when can that earnout be ultimately achieved?
Yeah, that's the whole negotiating topic, right? The whole points of the push and pull. You want to get bank-like execution with debt, the best of the bank execution, which is pricing, relationship, right? A good bank is going to be around, whereas debt funds are generally more hot or cold based on how much capital they have to deploy, right? Right now they're hot, but you also want to get the proceeds. Debt funds will win out on proceeds all the time. And so you structure that through an earnout. And then it comes down to, okay, how do I get the earnout? The blocking and tackling of what's your trailing period? And is it generally, it's if it's debt service coverage based or debt yield based, or it's all related, right? So it's really that. And then what happens is you look at the budget for the year. It's not really a pro forma. It's just more of a, we're going to burn off concessions. Other light value add, you may need a little bit more occupancy pull here. You didn't, you were fully occupied. But you look at the budget and you say, okay, based on your budget and based on this soft quoted earnout structure, when would you get this earnout? Are we talking a year from now? Are we talking 2 years from now? Well, what's your strategy for this mini perm loan? It's really a mini perm loan, right? It's not a perm loan. Are you going to the perm markets in 18 months? Well, if you're not going to get the earnout for 12 months and it's going to be on a trailing, you probably don't care. It's probably not that important to you. So you may want to focus on some other measures to pull, right? But if you don't know your exit and you may sell, not go to agency, and because you go to agency, you have to be comfortable with the prepay structure, right? So, but if you may want to open end it, do like a 5-year term, and you may want to sell, well, then maybe it's more meaningful to have an earnout, and you're okay if, for instance, you couldn't get it in year 2. This is not. I'm just talking general when I say year 2 earnout. I'm not talking about this deal particularly. So that's how we, when an owner contacts me about a deal, we walk through how do we get to their desire and their ask and when. I'm asking them constantly, what's your hold structure? What's your hold period? What's your exit strategy? Because our team wants to make sure that whatever we recommend to them, it matches their ultimate goal, if that makes sense. And so it coheres. It's not a square peg in a round hole.
Yeah.
Got it. All right, David. Well, thank you. That was an interesting one.
Sure.
Just quickly, the terms that you got from that bank, is that emblematic of other banks that you've been working with lately, or was it more unique to that particular one?
Thankfully, because we've got between 5 and 10 seniors deals in the market right now, and that's all pre-term sheet or at term sheet. And so we believe we have a good indication of who the debt funds are, who the banks are, and who the credit unions are. And so I'd say it's emblematic of the more competitive ones, but I'd say in general, the banks are 300s over SOFR. The debt funds are 375 plus over SOFR. The more aggressive ones are 375 plus. The more bridge to HUD guys are 400s plus over SOFR. And that pricing was, well below the bank pricing that the average banks are pricing. But keep in mind, when I give these average pricings over SOFR, that includes a lot of banks and debt funds who still have on their balance sheet assets that they'd like to get off their balance sheet before they can deploy capital. And those banks are risk rating, some of those assets are risk rated poorly, and so they're not able to be as active in today's market. I think that'll continue to abate a year from now, and so pricing will continue to come down from a bank perspective. Hopefully that's helpful.
Yeah, it is. Thank you. All right, Corey, want to take it away?
Yeah, yeah, you bet. So these are just a high level overview on, or this is a high level overview on the three acquisitions that Silverwave has tied up at the moment and that we're moving towards closing. And I think it's interesting because they share a lot of common characteristics. So, each of them, they're all value add. I think they sort of span the spectrum of heavy value add to lighter value add. Um, this they share a lot of the characteristics that Kyle listed at the beginning, some more than others, with respect to newer construction and positive momentum. Obviously, that middle one does not have cash flow, but it sort of checks all the boxes that Kyle listed, other than positive cash flow. And there's asset specific challenges at each of them, but really the reason for the slide is just to highlight that there's a really common set of circumstances with value add deals in the market right now, and it's these common characteristics I have laid out at the bottom. So there's in each of these markets there's no new construction underway locally. The performance has been steadily trending up. And this is true of all three markets, two more so than the third, but to a degree the third, that these markets really suffered from overdevelopment in the late 2010s. And you saw a drop in, when you look at NIGMAP data, you see a significant drop in occupancies. When you look at the buildings themselves, you see a significant drop in occupancies. And then challenges are compounded by COVID. And then there's just no new construction for several years. The market has a chance to absorb all of this new supply, and market occupancies have recovered. And then lastly, there's each of these is being acquired at a significant discount to historical valuations is probably the more appropriate metric for the older buildings, and replacement cost is the more appropriate metric for the newer buildings. And I mean, yeah, that's really all there is to say from a high level on all these. It's, I think it's why this captures why we're particularly focused on value add acquisitions is, when you look at each of these, common characteristics, it just fits perfectly with what everybody in the industry has been saying for the last 15 months. It's demographic picture is great. There's no new supply growth, and valuations bottomed and are starting to climb their way back up. And so we just feel like we're riding the upswing, riding the wave, so to speak.
Got it. Was that Southeast deal the one that you saw the most active bidding environment for, or maybe that was the toughest deal to get from a pricing perspective, or was it another one?
It actually was not. So I'd say the most competitive one was the Northwest deal. It's a very attractive asset with identifiable challenges that the right operators should be able to resolve. And so I think there was a decent amount of activity there. Although the fact that it's not financeable is certainly kept the activity muted to a degree. And frankly, there wasn't a lot of activity on any of these. One of them, I won't say which, but one of them is actually an off-market transaction, and we've really been focused on building up off-market deal flow. What we found is that last year, off-market sellers were by and large totally unrealistic with their pricing expectations. They were anchored to 2019 valuations, and brokers were really critical for the price discovery process, and it was really critical for a broker to get involved and tell them, your expectations need to come down. And so we actually viewed off-market transactions as largely a waste of time last year. But we've noticed that shifting, and it certainly depends on the seller. I mean, some sellers are more sophisticated than others and more attuned to the market than others. But we've by and large we found that off market transactions, the values are starting to reflect, the market that we're in. And it's just there's something so clean about an off-market transaction, skipping the process of competing with everybody else and just kind of going straight to, do we want the deal? Do we not want the deal? It's something we're really focused on doing more of.
Got it. And as far as holding these assets, particularly the late 90s and early 2000s vintage one, from your perspective, how do you see those operating kind of margin wise in 5 years from now, 10 years from now, if you're holding for 10 years, but how do you see them
Yeah.
operating 10 years from now or 5 years from now, especially if construction perhaps does come back in those markets?
Can I add to that, Corey?
Yeah,
How do
please.
you structure alignment with your operator? Because
Yeah.
that 90s, that's probably a higher acuity. That late 90s is probably higher acuity. So that's where my head's going operationally. Thanks, Ben. Let me tailgate on that.
Yeah.
Yeah, yeah, I'll take two good questions. I'll take those one at a time. So, Ben, on a 5 year time horizon, we're really not concerned about the threat of new construction. I mean, the data coming out from NICMAP is just so compelling with respect to this $275 billion supply gap, and the fact that, I mean, I hear everybody mention it, and I'll just mention it again. I believe, forgive me if I have this wrong, but I think I have it right, that NICMAP projects that by 2030, in order for industry-wide occupancy to remain below 90% based on demographic forecasts and historical absorption rates, construction would need to be twice its historical record level and 3.5x its current level. And it just feels basically impossible that that's going to happen. On top of that, you have growing timelines from, shovels in the dirt to communities are ready. And so I believe that the threat of new construction within 5 years is very, very low. I mean, not obviously not the threat of new construction at a scale that these communities are really going to be threatened. With all that, 10 years, totally different story. With all that being said, what I would say is to directly answer your question, Ben, if there is new construction, I think for costs have swollen so much that new construction at sort of a massive scale is only going to start to happen if revenues and bottom lines improve to the point that developers' underwritings, believe that they can suggest that they can cover the cost to build and earn a return. And so you need such significant rate growth, such significant absorption for that to really start to pencil, that I think that if the conditions materialize that encourage that level of construction, the communities that we've acquired are going to be so well positioned because of all the incremental rate growth and because of all the incremental absorption. And so, we're just very bullish, especially on that sort of 5 year time scale. On top of all that, our basis will be so much lower than the basis of the new entrants. And at least two of these communities were positioning them and will continue to position them. They are currently positioned, and we will continue to position them as middle market communities. And so they're going to be the communities that these communities are going to compete with have already been built. These communities are not going to compete with the buildings that come online for 500K a door in or 350, 4, 5 a door in the next 5 years. And so I hope that answers your question. David, in response to your question, we it, it depends on the deal, but broadly speaking, it's a co-invest that is meaningful to the operator, and then it is there's obviously all operators take their 5% management fee, but then there's alignment through a co-invest, and then there's additional incentives effectively tied to return on equity. So it's either promote sharing or it's incentive fees that are tied to capital events. It's not like NOI based incentive fees, because we try to avoid situations where the operator gets a payday, but the equity doesn't get a payday,
Good.
and then performance dips back down. And so it's kind of really, that's our model, and it just depends. It depends on the deal. We like to partner, generally speaking. It's, we're talking to operators of a lot of different sort of stars and stripes, but generally speaking, the reason that our acquisitions thus far have been successful and that we're optimistic that these will be successful is we're partnering with operators that are small, are local, and are programmatic relationships for us, and they're giving us, their full focus and attention. And if that changes, then we'll need to make a change. But I don't anticipate it changing because we're just very picky and very diligent about finding operating relationships where we believe that they're going to think like owners and they're going to be as motivated as can possibly be to bring these communities to to a successful level of performance.
Yep. Yep. And you can get financing for some of this stuff, but the question is, at what point does it just become too egregious? Because those debt funds themselves won't be able to get leverage unless there's enough cash flow where they can pledge that loan to a broader pool. And that's where it gets to be, like, frankly, 11 to 13%.
Yeah. That is something we're in the process of experiencing. That is, I mean, so what do you think, like, for the five, because honestly, we're just getting started hunting. We have debt. We believe we have debt for the 13% margin community, but we're just getting started hunting for debt for the 5% margin community. And that's a community with a great story. There's a lot of expense savings there that can be realized by, bringing in a different local operator. And, we've had some conversations with lenders where we feel like we've been able to kind of sell them on that fact. But if you're sitting in my shoes, you got it's good census, really strong revenues, but significant expense control needed. How financeable do you think that deal is?
Depends on operator alignment and the fund's ability to provide follow-on capital, and who's going to be the guarantor. These are smaller debt funds that aren't being levered, and it's going to be more expensive. And if your IRR unlevered is above the cost of their capital, then it'll benefit, but otherwise it may not benefit. But in anyway, it's going to be basically 11 to 13%. We're doing 2 deals like that right now, and there's only a handful of funds doing that, but they're executing.
Understood.
Thanks, guys.
That's helpful.
Corey, wish we had a little more time to cover those, but maybe we
let's
can
move on.
Well, maybe we can get more of the story and the context in the pages of the SeniorCare Investor when they eventually close as well. So
yeah, totally.
Everyone on the call can look forward to that too. Well, thanks for that. Kyle, you want to do the last case study?
I'll try to be quick here. I know we only got 13 minutes left of scheduled time. One follow-up piece, again, not to drag this out. We did not talk about in the institutional senior housing market, there is a flight to quality from an operator perspective. There is capital chasing certain operators. Not all operators are created equal. And I think that ultimately is driving and fueling a lot of the growth, right? Corey's got a Rolodex of operators that he knows and trusts and wants to do deals with. And I certainly think those types of alignment and relationships, GP-LP structures today are going to continue to be prevalent in the very near future.
Good point.
So let's talk about Kentucky, my home state, born and raised in Louisville. And so we have the benefit of having a number of on-market activity throughout the state. We wanted to talk about this specifically with regards to how has the M&A environment changed over the past 12 months. Well, July 1st of 2024, Kentucky rolled out its first Medicaid rebasing since 2008. An absolute necessity for the state and providers and operators and investors throughout. About $75 a day, plus or minus 30% of overall reimbursement. And, I think dating back even pre-July 2024, there was always interest within the state. There has been a lot of consolidation from an ownership and an operations perspective. Certain folks more attractive than others. Kentucky is a litigious state, so you're always going to have that PLGL risk. Tort reform's not coming, or at least anytime soon. Certain groups have figured out ways to kind of mitigate that. But in terms of the overall transaction activity and where pricing is today, it's been absolutely phenomenal. It's been great for us. Buyers are excited, and obviously, sellers that have been in these deals for a few years or owning and operating since the 80s and 90s. Are seeing outcomes that are really tremendous. So right now, just a little sample, we got 7 offerings, about 1,400 units, and about 230 million of overall transaction volume in various processes throughout Kentucky. So Ben, if you want to go to the next slide, we'll just kind of share some insights. So in terms of, there's a number of opportunities. There's portfolios, there's single assets, regional owner operators, looking to, scale down current portfolio, focus on what might be in their backyard. We're seeing some sellers, but also a more of the consolidation on the more local and mom and pop front as well. I think in terms of what ultimately has driven this increase is really the rebasing that happened last year. And we've seen a tremendous outcome. And so in terms of the interest, that we're seeing, from the marketplace, it's a mixture of both private and public capital. A lot of the private equity-backed owner operators with existing scale in the state are heavily attracted right now. I think they're seeing meaningful margin expansion across their existing Kentucky portfolio today. A lot of the larger players, have a ton of efficiencies from an operating expense perspective. And, they can come into these buildings, whether it's, improvement on your Medicaid rate through driving incremental changes on your CMI, bringing some efficiencies from an operating perspective. We're seeing cash flowing and non-cash flowing deals trade at premium levels versus, what was 12, 18, 36 months ago. And so, I think, Ben, you have some stats here, which would be great to see, but all in all, across all major mandates, we're seeing anywhere between 5+ to 10+ bids, a variety of different profiles, long-term incumbent players, new, younger, hungry owner operators with access to high net worth capital. Everyone is really making a shift and a push here. So, we have deals across, I'd say, non-performing and performing. On the low end, the non-performing side, smaller market, lower CMS star rated facility. We're seeing those trade north of 100 a bed. And then on the high end, there's a couple on-market deals under exclusivity that we're seeing trade north of 200 a bed. So all in all, particularly looking at the graph that you have here at the very bottom, what we're seeing and what we're able to capture today has been absolutely tremendous.
Yeah, that is significant. And just wanted to point out that that's the bottom bullet point here on the right.
Can I ask a question in here real quick?
Please.
So Kyle, for those operators who came to Kentucky, say 2021, 22, they came in at the right time, hindsight's 2020. Are they selling or are they buying and expanding? Or neither?
Buying and expanding.
Oh.
Yeah, buying and expanding for the most part. Not everyone, right? Certain folks like what they have, or they did a big deal 2 or 3 years ago that was a turnaround, and they want to focus on operations and make sure that they get that deal right. But for the most part, we are seeing an expansion of existing groups that entered the space within the past 5 to 10 years.
Wow. And what's going on in the sellers' minds to be getting out around now? Because in some way, couldn't they be missing the party with these new rates?
Certainly. I think a lot of them are fatigued, though. Right. I mean, like I mentioned, there's a variety of these groups that have been owning and operating these buildings for 10, 15, 30+ years. COVID was certainly very difficult for some of those groups. The state has been litigious from certain times. Staffing has not been the easiest on the nursing front as well. So there's always been a desire to trade. I'd say sometime within the next 2 to 5 years that eventually we are going to look at retirement and hang up the keys and be happy with what we did. I think ultimately what's pushing them today is the Medicaid rebasing, the profitability of the community, and then also, making sure that, we being local, to the state, making sure that we're having conversations with these potential sellers, letting them know what's happening in the state, letting them know, how certain deals or how certain buyers are evaluating these opportunities. And some of these have been conversations we've been having for 4 or 5 years that are just now making its way to an eventual marketing process. So, I think, again, most of it has to do with, wanting to exit the business. Certainly there's some, markets and or assets with an existing player. They just haven't figured it out, or it's an outlier from a region perspective. They might want to grow by shrinking, if that makes sense. But for the most part, it's the older cohort nearing retirement and wanting to hang it up.
Are you seeing a bifurcation in the operating performance of SNFs across the Commonwealth? Because, not everyone is going to be operating the most efficiently or maximizing their coding and billing under the PDPM system as others.
Yeah, no, there's a difference for sure. I mean, you'll see certain, even after the Medicaid rebasing, you'll see certain rates in the high 200s a day. You'll see some in the high 300s a day, right? And other operators, have full scale regional teams that can provide a ton of support. And we'll see those, kind of, perform a little bit higher occupancy, better mix, better margin, et cetera. So, again, there's still a mixture of both value add and I'd say light stabilized opportunities that we're selling right now. And there's a different type of buyer for each one of those as well.
But pricing is still increased significantly for even the not best performers in the.
Yeah, 100%. I think 2022, 2023, you get a small rural older SNF, break even or negative cash flow. You're probably looking around 50 to 60 a bed. Larger, potentially newer community, better mix from a private room perspective, more urban market. I think we probably saw some of those go 140, 150 a bed historically, but all in all, there's been a meaningful premium today.
Yeah.
Kyle, is Medicaid in the state, is Medicaid a managed care model, or is it directly billing to the state in Kentucky?
It's state pay.
Okay, interesting.
What other states come to mind as having similar significant jumps in their reimbursement rates?
Yeah, so wanted to make sure I chatted with the team about that. I don't cover every territory and spend a lot of time on the senior housing side, but talking with the colleagues, and I think we started to see it as well. I mean, something that's just south of Kentucky, Tennessee, absolute monster transaction that was recently announced and closed down there. Seeing some very favorable, Medicaid reimbursement, just general reimbursement and operating tailwinds. That's certainly been one. And I think also in the Pacific Northwest, you talk about Oregon, right? That's a state that remains hot. Nevada, we've seen some very big trades there. And then I think just generally as well, Florida, picked up, a little cooling off right now. Virginia's remained attractive, but, Tennessee, Oregon, Nevada, I would say are other areas right now that have seen, similar premiums.
Got it. And then in the coming years in those states or just across the country in general, what kind of buyer type do you see being the predominant force in the M&A market in SNFs? Is it going to be the kind of private, the family office type investors that are building their portfolios, or is it going to be regional owner operators? Is it going to be the REITs? What do you think it will be?
Yeah, I mean, I do think it's regionally clustered in terms of who's going to be more predominant than not. I think the publics will have been more active in this space and will continue to be more active for sure. And then you have some very, very large, national or super regional owner operators with access to private capital, whether domestic or overseas, that will continue to be a dominant force.
Got it. David, Corey, any other kind of questions on the case study that Kyle presented, or just the SNF market in general?
No, I think it's good intel. The Tennessee comment is very interesting. I know Tennessee was a hard state. We had seen some deals years and years ago there. So it's good to see. I'd like to see Texas pick up.
Agreed.
All right. Well, we're just at 2:30. I want to give you guys each a chance to kind of give maybe one last thought, something that you're excited about in the 2025 market, maybe something that could be unexpected that we'll see in the market, or anything you're just looking forward to. in 2025 M&A or the lending environment. Corey, do you want to start?
Yeah. I'm excited. Hopefully debt liquidity. I mean, I just want it to be easier. I want it to be easier to get bank debt, quite frankly. I don't, David's better positioned to tell me whether or not that's going to happen, but been hearing it for 6 months, for 9 months, and I hope that it's true.
Yeah. You guys can stay on the call afterwards. We'll hop off and you can chat about that.
I'll follow that one up. I might as well because it ties into debt capital markets. I mean, look, at Greystone, we're excited to continue to use our balance sheet. We're leading with our balance sheet, which the bread and butter is bridge to HUD. We're excited that the agencies, Fannie's going to become more competitive. They're lending more. And as long as the pricing comes closer to Freddie, it's going to be like it was hopefully 2022 and before, which would be good. And then from that side on, we've built an active debt placement desk so we can speak sanguinely to the whole market. And that is constantly taking real-time soundings into the depths of the bank, credit union, and debt fund market to see what places and where does it place. So we're just rounding out the whole spectrum.
Yeah, definitely the just overall efficiency in the debt market, a drop in interest rates would be fantastic. There's some correlation with cap rates there. But I think just to kind of go a different direction, just overall process is just becoming more and more efficient today than they were, 24 months ago, right? And so we're seeing across the board less retrade risk, for sellers. We're obviously seeing performance, improve across the whole spectrum here, but a steady and stable shift to become a more seller-friendly environment, and then just broadly running much more efficient processes, letting the market improve for our various clientele.
Great. Well, Kyle, David, Corey, thank you so much for taking the time today. That hour and a half really flew by. We did not get to all the topics that we wanted to cover, but we covered all the case studies, and I think that's what a lot of people were here for. So thank you so much for your preparation for this, all the work you put into it. Always enjoy our pre-calls too. And definitely a big thank you to Blueprint for sponsoring today's webinar as well. Very, very happy to be working with Blueprint in the coming months too. And as we see M&A really take off throughout 2025, it's been a wonder to behold, and I think it's only accelerating too. So with that, we'll conclude the webinar. But thank you each very, very much. It was a great conversation.
Thanks a lot, Ben.
Ben, thanks for having us. This was great, and I know we weren't able to answer all of the the webinar Q&A. So if there's questions that got unanswered, if you just want to shoot it to us in the background, we're happy to provide our 2 cents.
Yep,
Absolutely. Great
really
point.
appreciate it.
Thanks, you guys.